We are back with the show, Retire with Integrity. Brian, let's reach into the inbox here. Beth asks, she emailed and said, I own a string of laundromats. I'm 67 years old, widowed, and I'm ready to sell. The value of my business and property is $7.8 million. That's a lot of laundry. It said, my husband always told me I could sell to retire whenever I wanted to. Not sure I want to get out yet completely, but I've heard you talk about some trust where I could get out without managing. What is that all about?
Yeah, I mean, so not knowing enough about Beth, full disclaimer, I mean, she has obviously real estate laundromats or real estate.
$7.8 million worth. Good grief.
So the value of the business and property. So there's a value of the business, that's that's separate, right, from the property.
Oh, so the land and the buildings may be worth a lot.
Right. So I don't know how much the business is worth. Either way, there is tax strategies for both of those, right, depending on how it's structured, right? So a lot of times those are two separate entities. A lot of times the property is in an LLC, maybe even a sole proprietorship, and the main business pays rent to the other LLC.
Oh, yeah, right.
Right. And
I've heard about that.
It's a little bit of a tax strategy to avoid FICA tax.
Yeah.
But the point is that, once you sit down and you evaluate everything, there's ways to do a Delaware statutory trust, 1031 exchange of the property, or you can do an opportunity zone fund, which is a real estate investment. In fact, we've got one here. We got a calculator here. We're gonna put it on YouTube. So if you go to our YouTube page, you'll be able to see this, and we can put in any dollar amount. So she's got, let's say, her capital. The most important thing that she doesn't say in here, that I wish we had the information, is her actual capital gain, right?
Right.
So meaning, let's say that
cost basis stuff, is that what you're talking?
Yeah. Cost basis stuff. You are such a CPA.
I am paying attention,
this
man.
guy is like almost a CPA. You almost passed your exam. Anyway, so you're 7.8. Let's assume she's got a $5 million capital gain, right?
Okay.
Meaning 2.8.
She bought it for 2.8.
Yeah, with the depreciation.
Grew it to 7.8.
Right.
Yeah.
Okay. So if you have a $5 million capital gain, which is not a bad problem at all.
Yeah.
Hey, I'm jealous. So $5 million, she made some money, right? But she's done. She basically, the tone is, I want to get out.
Yeah.
Right?
She said she didn't want it. She didn't know if she wanted to for sure, but she felt like she was ready to sell, I think. Yeah.
Right. And so one opportunity is a qualified opportunity fund. And did we talk about those before? I don't know if we.
She said trust. Is that the same thing?
Well, so we have a Delaware statutory trust, which is basically 1031ing the money over, and that's a tax-free exchange. I say tax-free, it's really tax-deferred, but the idea is that you don't pay taxes on the transaction, right? Because you're not taking transactional receipt. Anytime you take transactional receipt of the money, the IRS goes, ding, oh, me.
Gotcha.
A lot of money.
Yeah.
So does Virginia, right? You owe the money. So in this example, let's say she took $5 million. I'm not saying she would do all this. She could do this after the fact. She doesn't even have to do a 1031 exchange for this. She could take $5 million, put it in a qualified opportunity fund investment. If she just sold had the $5 million, right, and paid the tax on it, and then she reinvested it over 10 years, it grew at 10% in a, say, a multifamily property or stock market, or whatever. She'd have $7.4 million after taxes. Okay. That's still pretty good.
Yeah.
I mean, that's enough to live on, right? Now, that's assuming she didn't take any withdrawals, right? She just took $5 million, paid the $1.4 million in tax.
Jeez.
And then when she sold her property and, her investment in 10 years, she had to pay another $1.6 million in tax, right? Because of the growth in 10 years. So how a qualified opportunity fund works is that she puts the $5 million in, and in 2027, I think it is, I can't remember now. Yeah, 2027, you have to, 2026 tax return, actually. So it's for 2027. You then have to pay the capital gains on the original investment. And then they give you the money, a lot of the money out to help pay the tax, right? So out of the fund, out of the real estate. And what is a qualified opportunity fund? It's real estate. There's a project that we were looking at for a client in San Diego. I mean, you would think, these zones, you think they're like the hood, right? They're like these really rough areas. No, it's a part of San Diego that's beautiful. Tampa. Tampa, they're selling $1 million condos right on the water, and this is an opportunity zone. The opportunity zone originally it was set up. There was like 77,000 areas. It was supposed to be like revitalizing America.
Gotcha. Yeah.
Right. Hey, Detroit, let's take this really bad area.
Yeah, they took the whole city blocks in Detroit and revamped them. Yeah.
Right. It was all an opportunity
Yeah, I
zone.
know what you're talking about now.
And so investors piled the money in because of this rule that, hey, I can take, just put the gain in. She didn't have to put the whole 8.7. She took the other 3 point, how much was it again? 7.8.
Yeah.
Yeah, so 2.8. She took the 2.8 and ran, right? She took the 5 that was the gain, put it in the qualified opportunity zone fund. After 10 years, what's left in it is completely tax-free.
Oh, wow.
So the difference between the two, we got a little calculator. Jake's going to be posting this on the YouTube page so people can see the difference. $11.49 million. The difference by doing tax planning with an opportunity zone fund, or you would have 7.4 million if she just cashed it out, paid the tax, bit the bullet like a lot of people do because they don't know any tax strategies, right? And that's just one.
That's significant.
If she's a charitable giver, we could do charitable gift planning with a pooled income fund on part of it, right? You could put $1 million in there. Of course, you have to do it before you sell it. So call us before you sell it.
Yeah.
Don't sell it and then call us, right? Because there's sometimes the things you have to do before you even get a contract. Because sometimes they call us, hey, I got a contract. I brought anything to do. I'm like, oh, well, you struck out 2 strategies. So that's okay. We have other things. And the nice thing about this, you can do it after the close. You have 180 days after the fact. So there's a lot of different things that she can do to minimize, defer, or eliminate the tax.
There you go, Beth. That's an important call. Here's the number, 866-2-PLAN-4, 866-TO-PLAN, and the number 4.